Corporate finance practice problem using OneNote. Stock dividend impact on equity and investor value. Get ready, it's time to take our chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side in the Practice Problems tab, then down in the 1828 Stock Dividend Impact on Equity and Investor Value tab. Also note when using OneNote, look at the immersive reader. Our presentations will be down in the text area as well. Same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we have our information up top, calculations on down below. We're looking at the stock dividend as opposed to a stock split. A little bit different situation, and we'll consider the equity section as well as the impact on an individual investor of the stock dividend. Focusing first on the equity section, remembering that the equity section is on the balance sheet, basically representing like the accounting equation, assets equal liabilities plus equity, or assets minus liabilities equals equity, emphasizing the fact that equity is like the owner or stockholder in the case of a corporation, who are the owners, claim to the assets of the company, as opposed to debtors, third-party liability claims to the assets of the company. We could think about that in aggregate as the owners as a whole, and then we need to break down to the individual types of owners. With regards to a corporation, we break them out by category because we have this chunks of ownership, those being the stocks. So we have these categories that look like this. We got the common stock at the shares of 4,000 shares in this case, and we have $5 par value. The par value does not represent the amount that we issued the stock for or the market price. It's an arbitrary number, making a nice even relationship between the common stock and the shares. Everything that we issued it for over and above the par value is then in the capital, paid in capital in excess of par. Therefore, the 20 and the 5 represent basically the owner's investment into the company, and that's different than the retained earnings part of the capital, representing the income of the company that it has generated, flowing through the income statement to the balance sheet in income that has been retained, therefore called retained income, which has not yet been distributed out. That's why it's retained in the form of dividends. It hasn't gone out yet in dividends to the owners, the shareholders. Okay, so then we have the stock price at $14. We got the earnings, basically bottom line of the income statement at the $21,000. We got the earnings per share at the $6, the price earnings ratio at the 2.67 about. We have the stock dividend finally at the 10%. It's going to be a 10% stock dividend. Once we're done calculating the equity section, we'll consider an individual investor who had 200 shares before this stock dividend took place. What's going to happen with that investors? We'll see. We'll find out. We'll get there shortly. Okay, let's take a look at the statement of stockholders' equity. This will give us kind of a recap first, and then we'll go through and do the calculations. So this is going to be different from a split. Remember, if you look at a split, you would think then that we have a situation where the shares are going to double or triple or whatever the split is going to be, and then the difference reflected in the par value, everything then being reflected in common stock. This is different. This is a stock dividend where we're perceiving that the owners are actually getting value from the dividends they're receiving, unlike a split where, because it's an even split, there's not really any more value being given to the owner. In this case, due to the fact of the differences that are taking place, it's not an even split we perceive there to be on the case of a stock dividend. So in this case, we have the 10% stock dividend going out, and we have the current price, which we're going to say is $14. So we're going to have to calculate the value of the reduction in the retained earnings in a similar way as we would if we were to issue the cash. And we're going to calculate that by taking the market price times the number of new shares. That's going to reduce the retained earnings. The earnings that have been accumulated that have not yet been paid out are now going to be paid out, not with cash, but with the value of the stocks that are going out. The other side of it then is not going to have an impact on the assets or liabilities because we're not paying out cash, as would be the case with a normal dividend, but rather it's going to have a change to the common stock and the paid in capital. The change to the common stock will be automatic in the sense that the shares will now increase because we're going to issue new shares with a 10% stock dividend, and then the par value will remain the same this time, which is different than a split, resulting in a change to the common stock. That means that the difference in the change in the paid-in capital will be the market price, $14, minus the par value of 5 times the new shares that we will change the paid-in capital for. So this is what's going to happen. Notice the end result is 53,000, just as it was when we started at, but we're going to have an impact or change to each of these components, including the common stock, paid-in capital, and the retained earnings, unlike a split where we only have the change to the common stock. Let's see the calculations, and then we'll recap it again. Pull it all together. Let's pull it together here. So let's calculate the new shares. The beginning shares, so we're going to start in the beginning before everything happened. If we go back as far as we know that we had shares at 4,000. 4,000 is where we stood in the beginning. And then, miraculously, there was a stock dividend that took place. It was a 10% stock dividend, resulting in an increase in the dividends, or new shares, I should say, of 4,000 times 10%. I don't need to put that in the calculator, but I wanted to anyways because the calculator is getting bored over there. I can see it. It was staring at me. The calculator wanted to be used. So we brought it over. The calculator's involved now. So how many shares are out there now? We got the beginning shares were 4,000. We got 400 new shares. That means that we're at the ending shares after this takes place at the 4,400. And then the par value stays the same, still at 5. So that means we have this automatic change that happened to the common stock at the 22,000. So we got the 4,400, 22,000. You can see that change happen here, 4,400 times 5, 22,000. We have that taken care of. Now, let's think about what's going to happen to the capital in excess of par calculation, which we can see here was at the 5,000. What's going to happen there? Well, we're going to take the stock market price of 14 minus the 5, because the $5 was already taken care of in the par value calculation. And this is going to be the difference between the $14, which is going to times the new shares, which is going to reduce the retained earnings. So 5 of that 14 already happening in the common stock or par value. So now we got 14 minus 5, or $9 that needs to take place within the paid-in capital in excess of par calculation. So $9 times the new shares, which we calculated up top to be 400 new shares, means there's going to be a change in the paid-in capital in excess of par of 9 times 400. Let's do that in the calculator because it's staring at me again. It's like, I can calculate that. So that's going to be the 3,600. And then we have the beginning balance of the 5,000. So it was at 5,000. It increased by the 3,600. That's going to bring us to the 8,600. Therefore, paid-in capital, as we can see up top, changed to 8,600 from the 5,000 beginning starting point. Let's look at the retained earnings now. What happens with the earnings that have been accumulated upwards that have not been going out in dividends and therefore are retained in the retained earnings area? In the beginning, as far back as we know, we had 28,000 in retained earnings. Then there was a dividend, stock dividend, resulting in new shares of $400, market price at 14. Therefore, we're going to assume that the owners of the corporation are getting value, not in the form of cash, but in form of dividends of 400 times 14, or 5,600, which is giving out the earnings in the form of a dividend, not a cash dividend, but stock dividend. But still, that should reduce then, we're thinking, the earnings that have been retained, because they're not retained anymore because we gave them to the owners in the form of a stock dividend. So 28,000 minus the 5,600, that's going to give us the 22,400. So we have the 22,400. So you can see up top, there is the 22,400. So once again, recapping this, we're imagining here owners getting value. They're getting value of $14, we're imagining, times the new shares, which we said was 400. That affects the retained earnings, decreasing it. The other side is not going to have an impact on assets or liabilities, needs to impact the equity section, and will do so between common stock and paid-in capital in excess of par. The common stock will be affected by the $5 par value times the 400 new shares, and the difference then of the 14 minus the par value is what the impact will be on the paid-in capital. 14 minus the par value times the new shares of the $400. That gets us to the end result of the 53,000, same number we had before we did this whole stock dividend process, but there is a change to each component, as we see here, of the equity sections that we have shown. Okay, so let's go on down and say, well, the statement of stockholders' equity, if we do a side-by-side here, then we've got the 4,000 changed to 4,400. Par value did not change. That's like the one thing that didn't change, and that's one thing that does change in a split situation as opposed to a stock dividend. They got the common stock did change, and then we've got the paid-in capital had an adjustment, and the retained earnings has gone down. Even though all those numbers changed, bottom line, ending number stays the same on the total capital. Okay, well, what happens with the earnings per share, you might ask? What about the earnings per share on a per share basis? We've got the earnings, which we're saying are the 21,000 at the earnings bottom line of, say, the income statement, the performance type of number. The ending shares, we said we're at the 4,400. There's 4,400 shares as opposed to the 4,000 before this. That means we're at the 4.77 at the earnings per share. Now, the earnings per share, we would expect then to go down because there's no impact on the earnings and we now have more shares out there. But if you are an owner of the company, you would have got an increase in the dividends given the 10% increase. So let's think about the price then. What would happen to the price? Well, and note when we're looking at the price, we're going to be taking into consideration the price earnings ratio, which you might first kind of calculate by looking at the price earnings ratio and then backing into, say, the price. Notice that this price earnings ratio at the starting point, we can consider it comparing the price to the earnings. So the price starting point would be the $14 price divided by the earnings. So the earnings up top, we can see we're at in aggregate. You can see here was the earnings we had. What are we? 21,000. So 21,000 divided by the number of shares that we started with was 4,000. So we've got the 5.225. So we started off with 14 divided by 5.25, and that gives us about our 6.67. So that's our price earnings ratio. And so then we're going to take that and say that the earnings per share now is the 4.77. So now we can get to our new price now. So we're going to say, all right, well, now the price is going to be that 2.67 about times the 4.77. And that's going to give us our price of the 12.73. So now we're looking at the price after this took place at the 12.73. So what's going to be the investor out value before the split? So before the split, remember our investor down here. Now we're looking at the investor, the individual investor, which had 200 shares of the 4,000 shares that were outstanding at the start. Then they had the stock price of 14. So 200 times 14 before we had the stock dividend was 2,800 total, 2,800. What happens after the split to our investor that had 200 shares? Well, they had 200. Then there was a stock split that happened that we've been talking about this whole time. And it meant that the 200 shares times the 0.1, 10%, added another 20 shares plus the 200 would give us to the 220. Or, of course, we can calculate that more quickly by taking 1 or 100% plus 0.1 or 10%, giving us 1.1 or 110% times the 200, giving us the 220. So there's the 220. Then we're going to pick up the price, which now we're saying is at the 12.73. So if we take that 220 times the 12.73, we're going to get to that 2,800 about. Notice there's rounding involved. That's kind of what you would expect once again, noting that the market could, the market, we're depending on basically the market to look at the price and how the market's going to react to it. But given the fact that we had a stock dividend and everything else remains the same, meaning no change to the underlying conditions in terms of assets, liabilities, or the earnings and whatnot themselves, there's a change to the earnings per share, but not to the aggregate total earnings. You would expect the market to reflect in this way if everything else was equal. And that would mean the shareholder was at basically the same spot before the split and after the split, even though they now have the more shares.